Your mortgage payment just went up. Blame the Federal Reserve, but not for the reason you think. Most people believe central banks set interest rates like a thermostat. They decide on a number, announce it, and banks follow. Simple, mechanical. Wrong. What actually happens is far stranger, and it starts with something called the overnight lending market, which most of us have never heard of but all of us depend on. Here's the accepted story. The Fed's policy committee meets, votes on a target rate, and that rate ripples outward. Banks borrowing overnight from each other suddenly have a new price to pay. Credit cards adjust. Mortgages follow. Your wallet gets lighter. It sounds inevitable. It sounds like the Fed has a lever they pull. But here's where it breaks down. The Fed doesn't actually force banks to lend at that rate. Banks lend to each other based on supply and demand, just like groceries. If banks have plenty of cash, they'll lend cheap. If cash is scarce, they'll demand higher rates. The Fed can't order this, so what can they actually do? They manipulate the supply of money itself. The Fed buys and sells government bonds, massive amounts. When they buy bonds, they inject cash into the banking system. Suddenly, banks are swimming in reserves. They have to lend that cash out, and when supply goes up, prices, meaning interest rates, go down. It's not a rule, it's physics. Do the opposite, the Fed sells bonds. Cash drains out, banks scramble for reserves. Suddenly they're charging each other more to borrow. That higher overnight rate spreads like a ripple. Credit cards climb, home loans climb, your paycheck buys less. The mechanism isn't a command, it's leverage over scarcity. Now the implications snap into focus. When the Fed raises rates, they're not trying to punish you. They're trying to slow down spending to cool inflation. Less money chasing the same goods means prices stop climbing. But that slowdown has a cost. Businesses hire less, wages stagnate, people default on loans. The economy contracts. Sometimes it hurts. The Fed faces a permanent tightrope. Raise rates too fast and you trigger a recession. Keep them low too long and inflation spirals. They're not omniscient. They're working with incomplete data, guessing at future inflation, hoping their lever pulls the economy in the right direction. Sometimes it does, sometimes it doesn't. Understanding this matters because interest rates touch everything: your rent, your debt, your job security. They're not set by magic. They're set by supply, demand, and the Fed's best guess about the future. Knowing how the mechanism works helps you see the economy not as something that happens asterisk to asterisk you, but as a system you can actually understand. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to keep uncovering how the systems shaping your life actually work, not the headlines, the mechanics. This video is for educational and informational purposes only and is not financial advice. Always do your own research.